Since a strong US dollar tends to be a negative for both global stocks and commodities, let's review the short and intermediate term outlook for the US dollar to see if it can help us better manage risk in our portfolios. What we're looking at here is a daily chart of the US dollar index, which is the dollar versus a basket of foreign currencies. The takeaways here: 200-day moving average, unlike the S&P 500 index, the slope of it is still negative, which tells us the bias in this market from a long-term perspective is still bearish. However, the 200-day in this area is trying to flatten out. It has not done it yet. It's still sloping downward, which tells us the bearish bias is still in play. If this 200-day were to flatten out here, it would tell us that the odds of a break above the 200-day in a bullish manner would increase. So the things that we would look for here would be a flattening out of the 200-day would be a negative sign for commodities and stocks. And more importantly, if this 200-day can turn up and get a positive slope, that would be bullish for the dollar and bearish, all things being equal, for U.S. stocks and commodities. These green arrows show us an intermediate term or short-term bullish development in the U.S. dollar. This is a series of higher lows, which is something that you need in order for a trend to change from a negative trend to a positive trend. However, this full stochastic indicator tells us that the enthusiasm for buying the dollar is waning. Notice the slope of this line in price is for the most part flat. It's sloping downward somewhat, meaning we were not able to exceed this high in this area, nor were we able to do it here, which is not all that bullish. But more importantly, the indicator shows us that the interest in buying the dollar or the momentum in this move is getting weaker and weaker on a short-term basis as we try to exceed this high here. So this leans slightly bullish. This leans slightly bearish on a daily chart, showing us somewhat of a mixed bag, but the longer-term bias, as long as this is down, is bearish. Shifting gears here to a longer-term view of the U.S. dollar. Here we're looking at a weekly chart of the U.S. dollar index. Takeaways here fairly simple. The 22-week in our eyes is somewhat synonymous on a weekly chart with the 200-day moving average. It's a good bull-bear demarcation line to use. Takeaways here similar to the daily chart. Negative slope on the 22-week, bearish from a long-term perspective. Notice the 22-week has acted as resistance here in mid to late June and again in mid-July. So the bias for the U.S. dollar from a long-term perspective based on a weekly chart and the 22-week moving average remains bearish. This slope is negative. What would be bullish for the dollar, similar to a daily chart, would be if this slope can flatten out, price can exceed this 22-week, and most importantly, if the 22-week can turn up in a bullish manner. Another takeaway, this move here has not been able to break through this RSI resistance. The general takeaway here is fairly simple. Notice RSI is an indicator that goes from 30 to 50 and then from 50 to 70, basically. Bear markets tend to stay in, let's say, 55 or 56 and below. Bull markets are just the opposite. The RSI in a weekly chart would have a tendency to stay in this upper region. So notice RSI is definitely in a bearish region on a weekly chart, and it's remained there. This is a lot of white space up here in RSI. If this RSI can break into this white space and especially stay there for a time or make somewhat of a convincing break above it, that would be bullish in the dollar. Takeaways here: bearish slant in RSI still. We haven't broken above the orange line. Bearish slant in the 22-week. A break above it would be bullish. Flattening out would be bullish. Turning up would be bullish. Right now, this chart leans bearish currently for the dollar, which would be bullish longer term for the stock market and commodities, as well as precious metals.